Hey everyone, welcome to part two, or whatever part this is, to the MACD kind of breakdown. So what we're going to do is we're going to do a session back test. We're going to look at from February to April of 2026, and it's going to look at a bunch of trades, okay? And I separated into three time frames. So you have the 6 a.m. to the 1 PST time, and then you have when the market opens again for the futures to midnight, and then midnight to opening market, right? And what you'll see is you'll see something very interesting. You'll see that the win rate is incredibly low at 41%, and the total return is 2.7, right? You're like, that's crazy. Why is my win rate so bad, but my return is doing so well? Well, the thing about MACD is that it's momentum based, and typically momentum based, meaning that you catch all of the ones where they go crazy, right? So instead of focusing on sideways movement, you catch the big movers, okay? Now, that means that if you're trading with MACD and you try to catch all the little ones, right, you may miss the big one that goes, right? But you need to have enough equity in order to go through the losses. And the problem with a lot of the back tests, even when I perform it, is that there's no clear indication or no way you can clearly replicate what is the best where spot to end. Even on a back test, because you have historical data, so then you can keep tweaking it. But then when it happens in live data, sometimes it check marks it as okay, do whatever you gotta do, right? And then it does what it does, right? So in this case, you catch all the big ones. That's why your return is a lot larger than your losses. So keeping your winners bigger than your losses. And you can see that when you buy, you sell at the subsequent like down arrow, right? When it does a bearish cross. It's very simple, right? Buy as it goes up, sell whenever it hits a cross, don't play opposite direction. And it's really nice here that we can see that there are some times where these are unnecessary losses. Like you can avoid doing this kind of loss. You can avoid this loss. You can avoid this loss, right? By just not trading, right? It's a bearish day. It looks like a bearish day. So you can do that. And even on these small ones here, you can win. You can win a little bit here, right? This is a smaller time frame here. And let's look at the evening. So this is 3 to midnight, and you can see that it actually doesn't perform well. The win rate is incredibly low, but the return is also low, right? Now you do have room. You can go up to 1%. You can also lose 0.5% of your portfolio, right? In comparison to this one, it's pretty much the same, right? But your return might be really bad if you're just trading blindly. So following the MACD is not such a good idea, right? And you can see that when we break up, sometimes you'll experience this significant bump, right? But do you see what happened here? There was no MACD to really sweep up the gains, right? Indicator, something happened to the indicator here, right when the market opened. So you can have stuff like that. You can totally just miss out. While we have the overnight actually did the best. It had almost 5%. You could have a 2% up as the best, while you could have 0.33. And then the average win is not bad, and your win rate is closer to 50. And, when we look at it, we can see that a lot of the structures here look a little bit sideways. Um, this one you didn't have to play, pretty bearish, right? This one you caught, maybe you did, maybe you didn't. It looks like if you were blindly playing it, you might have caught it, but a lot of times the 4 o'clock, 5 o'clock is red flag news. You can't trade it if you're with the firm, so then all that kind of stuff. So in the end, based on my back test, even with a really poor win rate, you can still win or have a good return. Intraday. The issue is really just looking at it and determining whether it follows that trend, right? If it's a bearish trend, you're not going to try to just buy in every cross, right? And if you want to see more, right? If you want to see the opposite, we would go in and say, okay, what about if I just sell on every bearish cross and then recover by buying it back on every bullish cross? Let me know in the comment, right? We could do that too. But typically it's better if you were to pick one direction to be biased on in a certain market frame, right? In a certain time frame, is to be bullish, right? So in this case, this is the bullish scenario. Okay. Other than that, I hope you enjoyed that. I hope you found that insightful. If you have any recommendations, please let me know. Otherwise, take care and have a good day.